You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is Danielle Park, editor of the popular blog Juggling Dynamite and president of Venable Park Investment Council Incorporated. Welcome to the show, Danielle.
Hey, thank you, Jim.
Just before we went on air, I was joking about the less than 1% solution, the Bank of Canada lowering the central rate to 0.75%. Is that going to do anything to boost the Canadian economy, considering the oil patch is slowing down and closing down?
No, I would say no. I think it was purely symbolic. It was a recognition of the severity of the impact of the plunging oil price on the Canadian economy. One of the more honest comments from a central banker came from Mr. Poulet this week when he said that it's unequivocally negative for the Canadian economy. You know how most places you've been hearing people talk about it's better for this sector and it's better for that, and on balance it's probably a good thing? Well, he was honest in saying for Canada, at least, in terms of revenue, in terms of growth, GDP, jobs, and capital spending, it's, unequivocally negative. And so, not only do they see it as a present problem, but they see it as something that's not likely to remedy quickly, and they see this slow growth phase continuing. So the last thing in the world, the central bank, if you think back to when Mr. Carney was in charge and they were issuing, these warnings about the consumer getting too indebted, and when the Canadian banks first offered 5-year mortgage rates under 3%. Remember, Mr. Flaherty reprimanded them and said, that's not what we need. We don't need that, that extreme easy conditions for consumers in Canada because they were already in debt so much. So the last thing this central bank wanted to do was give another rate cut to consumers. But on the other hand, I think they felt they had really no choice, because with the energy sector imploding and the U.S. dollar soaring, again today up another 1.2%, the U.S. dollar index, Jim, that just means the cavitation in commodities continues with a vengeance. And every time that happens, of course, we have to hope for some kind of weight from other sectors, and so the export sector will be helped a bit by the falling Canadian dollar. And I guess he's just trying to do whatever he can with the levers he's got. But again, this goes back to the whole problem coming into this downturn, which is unprecedented, Jim. We've never had this little monetary ease available to the system. Coming into this downturn, historically coming into downturns, you always have central policy rates around 5.5%. So today, when the world's at already 0.25, and 1% in Canada, so they can cut rates by 0.25, but really is much more emblematic than it is effective.
The European Central Bank has announced more quantitative easing. Please tell us about it.
They announced that starting in March, they will begin buying. Now, if you look at the shock and awe of the headline, it's $60 billion euros of bonds a month is the authorized amount out of the ECB this morning. Mr. Draghi held a press conference and, dropped this big number. That amounts to, if they were able to achieve that much purchases, it would add another $1 trillion to the ECB balance sheet, which would take them back up to where they were about that level in 2012 when the euro crisis was raging. So they're trying to recycle. It's one of these similar tactics that we've seen in all the other sectors and countries that have been awash in bad debts, and they try and buy up the bad debts to provide a bid and keep rates low and, keep the finance sector functioning and keep people from having to admit mistakes and write off bad debts. So they ostensibly say that it's to keep rates low and help consumers, but ultimately it's nothing to do with that. It's all about the banks. Now, the thing about what was announced this morning, although it sounded like a big number, when you drill down into the meat of the matter, there's a couple of things that really stand out. One is that they've limited it to investment-grade securities, which may sound like no big deal, except that means no bond buying for countries like Greece or Cyprus. So the most tenuous members of the EU who are, at the verge of a debt collapse basically are not going to be part of this bond buying program. So that's one thing. And you've got the Greek election coming very soon, and there's a lot of momentum there to leave the Eurozone. So the fact that this ECB package today is not going to help them with their particular debt problem may add more fuel to the potential that they will vote to leave the the EU. So that's one thing. And the second thing is that when you look at it, this is not the central bank of a country like Japan or the U.S. where they announced QE and it was them doing the buying every single month. In this particular scenario, it's only 20% of the bond buying to come from the ECB itself, which is the members of the including the Bundesbank. So this is this sticky point, right? All along it was whether or not Germany would agree to write checks to buy the debts of these weaker countries. And in this case, they agreed to apparently, it's called the risk-sharing portion. In this case, they've agreed to 20% of the $1 trillion in potential buys to be bought by the ECB, but the rest of the monies or the rest of the bond buying is to be done by the member central banks themselves of their own bonds. And then there's a cap on how much they can consume of their own bond market. So that's a scenario where you've got a lot of these constituents, if they're going to do bond buying, it's going to be the Germans are going to buy their own bonds and, et cetera, et cetera. Now, the plot really thickens, Jim, when you appreciate that so many of these countries already have negative yields. So what it means is that they are going to be paying more than par for something that will naturally mature on their books at par. So to give you an example, Switzerland right now, their 10-year bonds are negative yielding. In other words, you have to pay more today than it'll mature at in 10 years. Germany also has that through 6 years. They have the negative yield. French bonds through 4 years. Netherlands, you have to go out at least 4 years to be able to get any kind of yield whatsoever. So it's interesting, right? They're essentially saying that if they do buy their own bonds at these prices and hold them to maturity, they're guaranteed to lose money. So it's really just one of those prestidigitations of desperate bankers who have, the same policymakers who, helped the world implode on debt in the first place are still at the helm of these monetary agencies, and they're still desperately trying to prove that they weren't a screw up, that they actually knew what they were doing, when in fact, obviously they've done catastrophic things for the world financial system. So it's I'm kind of relieved that he finally rolled that out this morning, because it's been hanging, it's all this pomp and circumstance and promise, and imagine if the ECB was to unleash QE. Well, they did. And the things that matter in the real world, things like commodities, are plunging today, Jim. You see a big sell-off again in energy and lumber and copper, the things that matter in the world. Natural gas was down about 6% at one point today. So that, and you had government bond yields and the U.S. dollar surging. So that just compounds the problems, because you're now sucking more capital out of these weaker economies, struggling markets, repatriating it back to what's perceived to be the strongest economy today, which is the United States. And as you have that reverse carry trade happening, money's coming out of risk markets and risk sectors and assets all over the world, which just means less liquidity there. And then it brings about a bunch of violent shocks and adjustments in price for many of these things that had intense leverage. And what happens is, like with the Swiss franc episode last week, you get a 30% move in minutes when capitulation finally hits and they give up trying to artificially support a price. You get a massive swing that wipes out a whole bunch of levered players. Once they're all wiped out, now they've got to liquidate whatever assets they have left, or they've created holes for the banks that have been backing them. So it's really a very cancerous effect. And so I'm kind of glad we got there. It takes away that quote promised magic, and now we live with the reality again. And I think that any bounce in risk assets here, for all the reasons that I've explained about why this QE doesn't pack the punch that we saw even in the American versions, I think this rally is probably going to be disappointing for many people.
We'll have more with Danielle Park right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with Danielle Park, editor of the popular blog Juggling Dynamite. If what's happening in Europe is poison, what is happening in Russia with all this?
Well, Russia's got the same, levered exposure to the energy sector at the time that it's on the outs with the world and facing all these sanctions that had already put its economy under great distress, and now you've got this plunge in its revenue. So it makes it, just more vulnerable. It's another economy already in recession. It's another weak currency in the world. It's another place where capital's fleeing as fast as it can. And it gives more bid to, as I say, the U.S. as a relative safe haven. So anyway, every time, it's this vicious circle, because every time the commodities fall, the U.S. dollar surges and vice versa, and you have this, perfect mess for everybody else who are already, a lot of these markets were already driven by highly levered participants and high frequency trading. And so there was a lot of phantom liquidity to their markets in the first place. When you have that evaporating quickly and very few people wanting to bid for anything there, you get a lot of crunch, crisis and capital crunch happening all over the place, which only magnifies, so an example is, how everyone's been so taken aback by the rapidity of the decline in energy, and that's hit everybody broadside because very few people were aware of, I don't know why they weren't aware of this. The cycle has always been there, I guess because it's gone on so long and it became complacent, and they believed central banks could always rig and jig and maintain prices no matter what. Well, since that big collapse and all the knockoff effects we've seen the past 7 months, it's now starting to become apparent that a lot of the institutions that are very exposed to the crumbling in the energy sector in terms of the assets, the bond prices that have plunged by, 20 to 80% in some cases, the securities themselves that, were goosed up on all this leverage the share prices have been falling. And you see that the IPO market, everything that was going so well for them when the capital was flowing in, has suddenly violently reversed. And of course you realize then that the people that were selling the risk, that were packaging it and selling it, that the investment banks that had helped to drive so much exuberance into that sector the past cycle are now also starting to suffer losses as a result. And of course they're going to try and cover that up as much as possible, do a creative accounting, offsets and that sort of thing. But at the end of the day, there's a lot of exposure to energy and these deflationary forces that are happening in the banking sector, both in Canada and America, actually all around the world, but particularly in North America. And that matters because those sectors are violently overvalued currently in the Canadian market, for example, and U.S. shares too, to a slightly lesser extent. So people that have bought these things, Jim, because, you've got this terribly low rate environment, everyone desperate for yield, all the banker brokers telling everyone to buy their, quote, conservative shares, are going to be just blindsided once again by the rapidity and violence of the decline there. And it'll be very harmful because it is the most broadly held sector. Finance shares are late performers. They've held up longer than most. They've sucked a bunch of people who shouldn't be exposed to a lot of capital risk in the first place into them in concentration. And that's why I'm sorry to say that's going to be one of the most harmful impacts of all this unraveling, is that people that are holding what they believe to be conservative because they've been told they're conservative holdings are going to suffer big losses now.
Well, I remember you telling me months ago people who had their money in the banks were going to start to see losses, that the banks had done a good job of hiding it. And in fact, I remember the start of the last New Year, after the Bank of Montreal posted record profits, the first thing they did was lay off 1,000 people, and you said, get used to it.
Yeah, because, if you think about what happened, Jim, in the credit bubble, how the consumer credit bubble made a massive oversupply and too much size in retail, as an example, in cars manufacturing, pumping out cars because everyone could get access to cheap loans, not because people could actually afford the cars. So you have to now have a downsizing in all those sectors that were the excessive recipients of that liquidity. And so that's what we're seeing in commodities. It's been mean reverting since 11, but with a vengeance of late. It's what you're seeing in things like the Canadian dollar, which had become incredibly overvalued for these very same factors, billowing up with the credit bubble and now billowing back down in a sharp fashion. And that's why the finance sector got way too large. It was it's like too much blood flow going to that particular clump of cells, and now it got way oversized. And you're starting to see that, right? You have layoffs announced this morning, a bunch of financial companies. So first you saw it in the energy patch, and that's been abrupt and rapid. People are getting pink slips by the thousands each week. And now it's feeding into the financial sector because there's layoffs, because the underwriting business is gone, because the consumer's already distressed and now they're being laid off. So this vicious cycle begins again, and the credit card companies like American Express laid off a bunch, like, eBay announced big layoffs, 7% of its workforce this morning. So I think you're going to see that this trend is a pretty persistent one for the next several months at least, where people just keep getting, the knockoff of one sector's weakness, bleeds into the weakness in other sectors, because it is a very interrelated economy, really. And so that's what'll happen. And then, it'll take people by surprise, unfortunately, because as I say, as we've discussed many times, this is a part of every cycle. But the longer it goes on and the more complacent people become and the less they save and the less they pay down debt and the more they believe that central bankers are wizards, the more precarious they are and the more vulnerable they are to the downside. And that's where we are right now. We're more exposed now than we were in 2007, and you know how violent that was, the Great Recession. The Bank of International Settlements ex-head Bill White was speaking, this pomp and circumstance in Davos this week with all the financial heads there like rock stars. I live for the day when we will think of that as an embarrassing sight. I mean, I already think it's an embarrassing sight, but I think that the popular culture will come to see it as increasingly embarrassing that these policymakers and bankers get together for this big snooze fest, in this elite place. And they're accomplishing nothing. They're acting as if they're in charge of the world economy. In fact, what they've done is harm it, but not help it. And so the head of the BIS, the Bank of International Settlements, was admitting that in an interview that I put on the blog just today. He was saying, we've created a mess here, and it's far worse than in 2008 when he said I was concerned then about the Great Recession impacts that we're building, but this is worse now. And that's just the facts.
Mm-hmm. And then what about the Oxfam report that says 1% of the world's population is going to control more than half of the wealth within a year or two? Are we going to see revolutions when that other half says we'd like a little piece of that 1% pie?
Yeah, well, historically that's always been the great equalizer, that eventually you get some event or toppling of the powers that be. It's been extremely persistent and stubborn this time, and the QEs have really helped that process, have allowed the concentration of wealth in the hands of fewer and fewer people. Because of the malinvestment, money hasn't gone into innovation and R&D and education of the workforce and intelligent technology as much as it's gone into speculation. And for that reason, it's been very counterproductive to anything meaningful or lasting in terms of progress for humanity. So, yeah, you got to think at some point, I mean, this ECB stuff, to whatever extent it continues to float the banking sector for a little while longer, will obviously just contribute to that inequality trend and make it even more grotesque than it already is. And there's got to be a breaking point at some point. Now, perhaps it's already happening because these over-levered institutions will begin to fall on their own sword once more. And then the issue is, from whence do they expect to be bailed this time, right? If you notice the financial system, or the governments, as I said, the central banks are already out of bullets on monetary policy, so it really isn't clear to me that there would be any political will, although they would no doubt try and want to come up with some kind of a bailout. Someone said to me this morning, do you think that the Canadian government is going to try and bail out the energy sector the way the U.S. government bailed out the car sector in the last recession? I guess it's an excellent question, but at some point you have to think, with what money? With what access to capital? The Canadian dollar is crumbling. Our interest rates are already low. We don't have even the deep pockets of a benchmark currency country to be able to pour endless amounts of money. And we have a much smaller economy, much smaller population. So it's tricky. I don't see where the obvious person to write checks will be in this particular crunch.
Are there any sectors in Canada that will enjoy prosperity? I'm thinking perhaps tourism with a lower dollar.
Absolutely, that'll help. There will be, Canada's still a lovely place to visit. I'm sure it'll, just like everyone was talking about the impacts to the Swiss economy being negative for the export sector with their currency surging last week. That's true, but it's also true that it's all of a sudden cheaper for Swiss people to go out and buy stuff and to buy things in euros and to take trips abroad. And so there's definitely some of that will be positive in terms of people wanting to come and buy Canadian goods and come visit Canada. There will be, there's always going to be, in my view, a place for nimble, savvy business people to find a way to make their businesses make sense and to work and to adjust to new climates. I mean, successful business people have to be nimble and flexible, and they can figure it out in a lot of cases. The ones who are the least levered and have, the most things paid for and the less fat in their budget are the ones who will prevail and be there to pick up the new business channels that come out of this. So it's a question of survival of the fittest. That's always the way it's been, Jim. The past few years we've had a bunch of people throwing money at people that ought not to have had capital flows, and that's extenuated the problems that we are facing right now. But I still remain optimistic that lean and mean people that know what they're doing and how to manage a business and how to manage cash flow will always be able to come through these things. And they will, hopefully the ones that are going to suffer this cycle will learn this lesson once and for all and will not make that same mistake in their lifetime. In other words, will learn to hate debt, will learn to pay things off as they go, will learn to build up their savings, will learn to not believe central bankers are wizards, and the world will be a better place.
Is it time to take your money out of the bank in case they decide to bail out the banks?
Well, the trouble is, and this is the trouble the world faces everywhere. If you put the money in socks and you put it under your bed, you can maybe do that with some of it, but it's pretty precarious, right? There's danger in everything that you're doing there. So at this point, I think, the largest big six Canadian banks, for example, are the most capitalized that certainly is available in the country, and there's going to be no doubt, I think, losses to the equity holders at this level. I think that the shares are going to come down in value a lot. Some of the long-dated bonds and exotic credit products that were issued in the past few years, I wouldn't be holding those. I think that there's quite a few buffers of capital that stand to lose in the banking structure before you get to anyone's deposits. So I'm actually not talking about the likelihood of losses to depositors at this point. I don't think we're Cyprus, but I do think that the capital structure in Canadian banks is overpriced, that bonds and equities have a good deal of absorption likely coming to them in terms of downside.
Good. My 10 cents is safe.
Hopefully.
Thank you very much, Danielle.
Okay. Thank you, Jim.
My guest has been Danielle Park, editor of the popular blog Juggling Dynamite. Her website is jugglingdynamite.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. Comments about the show can be sent to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.